Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. All right. Today, I want to talk about claiming false tax credits on your tax return, the penalty for that. I've actually been seeing a lot of traffic on that lately. And the word on the IRS streets is that they're really focused on enforcement of claiming these tax credits. And we're talking about the common tax credits that a lot of middle and lower income people are entitled to. So those credits are the child tax credit, the earned income tax credit, the American Opportunity Credit, and the lifetime learning credit. Okay. Now, let's talk about the difference between a credit and a tax deduction, a tax credit and a tax deduction. The difference is a tax credit is a dollar for dollar reduction of your tax bill. Some tax credits are refundable, some are not. And what that means is that they can't take your tax liability below zero. So if you have a refundable credit of $2,000 and you have a tax bill of $500, well, then you get that balance, right? That means that you get a refund of $1,500. But if it's a non-refundable tax credit, and in the same scenario, if you have a $500 tax liability and then you have a $2,000 tax credit that's available, if it's non-refundable, then you'll only get $500 for that credit. So we have credits that are refundable, some that are non-refundable, some are partially refundable, and then they're phased out based on your income, all of that stuff. There's a lot of different types of math depending on the credits. So that's tax credits. A tax deduction is based on a percentage, and the value of that tax deduction is going to depend on your tax bracket. So a tax deduction could be worth 25%. It could be worth 10%. It really just depends on your income tax bracket as to how much that tax deduction is going to be worth. So a tax credit is a dollar for dollar, where a tax deduction is based on your income tax bracket. Okay. So this is why tax credits are way better than tax deductions. But what's happening? We've got too many people who are now claiming false tax credits. And this is not new. This has been something that's been happening for many, many moons. You've heard of people selling their kids' social security numbers to, their friend down the street because they have more than 3 children, and, somebody needs to claim these kids. All that stuff. This is absolutely unacceptable, and it's against the law. But now in recent years, there have been penalties put in place for this. And I don't think enough people know about these penalties to really understand what it is they're getting themselves into when they're claiming these false tax credits. So like I said, all of the common tax, there's lots of different tax credits. Well, I'm just talking about the common tax credits, but they all kind of fall into the same boat if you're claiming fraudulent stuff. Okay. So, people who fraudulently claim credits can be barred from claiming those credits for up to 10 years. Okay. If let's say, the way the law is written is that if you're found to have claimed the credit with reckless or intentional disregard of the rules, the bar applies for 2 years. Basically, if you get caught once, you're going to get a 2-year bar. Okay. But if you continually do it, then you can be barred for up to 10 years. And it doesn't matter if during that 10 years you actually qualify to claim that credit, because you have now been barred. You can't claim it. And we see this happening most with the earned income tax credit, because that is our highest paying tax credit. When people claim children that do not belong to them to get higher earned income tax credit. And when you do that, both the person that can legally claim the child and the person that fraudulently claimed the child can be barred from claiming that child, period, for 10 years. So that means, depending on the age of the child, you may never be able to claim that tax credit again for that particular child. Okay. And so Along with that, though, being barred, there's also a civil penalty that can be incurred. Now, the civil penalty can be 75% of the amount that you owe. So how does that look? So let's say you got a $2,500 tax credit of some sort. It doesn't even matter what it is. $2,500 credit. And if you are found to have, fraudulently claimed that credit, you can also incur a 75% civil penalty. So that is another $1,875. So you might have to pay back $43.75 for this $2,500 credit that you claimed falsely. That does not include the interest from the time that you claimed it up until you pay it off. So if you get busted from, 2016, so then you've got interest that's going to accrue from the time that return was due up until you pay it off. And also understand that there is no statute of limitations on fraud. So if the IRS goes back to audit your return that 3 years and they find that you did something shady, okay, then they can go back and review some more returns. And they can go back until they stop finding stuff. Okay, so if there is no statute of limitations on fraud, so don't sit there and think, oh, well, if they haven't caught it in 3 years, then they're not going to catch it. That's not necessarily true. If it's fraudulent, then they can go back, okay, for as far as they can find, and you will have to pay. Okay, so that's the thing on fraud that people need to know. But listen, you guys, there is a push, like I said, on these IRS streets to really enforce and catch this fraudulent stuff. Okay. And unfortunately, for middle and lower income people, it is easier to catch you in an audit than it is the wealthier people, simply because of automated matching, right? So what that means is that the IRS has a computerized, automated underreporting system. And what that means is that, if you claim something, let's say you claim the American Opportunity Credit, right? And you're supposed to report with a 1098-T. Now, there are plenty of people that are running around here with fraudulent 1098-Ts, okay? But when they go to match these things up, they're looking for a 1098-T with your Social Security number on it from the issuing institution. And if they don't find one that matches, well, guess what? Now they're coming back to you for you to show and prove that this 1098-T is actually legitimate. So it's not just going to be, showing a 1098-T. It's going to be showing some receipts for some tuition. And if you can't show receipts for tuition, well, now you've committed fraud. So computer matching at the IRS is starting to catch a lot of these things, and the agencies are starting to talk to each other. So, we talk about the earned income tax credit and claiming kids that don't belong to you. So if Susie is claiming Jack this year and Sarah is claiming Jack the next year, and then, Tyrone is claiming Jack the third year, the IRS is going to be like, wait a minute, where does Jack actually belong? And so then they start sending letters to you for you to prove that Jack is your kid to claim. And if you can't provide that documentation, all y'all getting busted. Right? The ones who got the earned income tax credit pertaining to Jack and the child tax credit pertaining to Jack. If you were not legally entitled to receive that, you're going to have to pay that back. You will have to pay the civil penalty. And if it turns out that basically this is a ring of some people selling Social Security numbers and renting kids out, then everybody's going to get busted and nobody's claiming Jack ever again, for 10 years. Is that what you want in your life? Right? And then also, you have to understand, as tax professionals, we've got skin in this game too, because the IRS can fine us $500 for every time we don't complete the required due diligence. And see, taxpayers really want to get upset when we're asking these probing questions. And you know what? It may seem invasive to you, but we have to protect our business too. Because if we don't ask the right questions, if we file a return that we don't feel is, everything is on the up and up, we can be fined $500 for each and every instance of not doing due diligence, not, asking those questions, looking and asking for documentation. And so this is why if you have a reputable tax professional, if you can't produce those documents, they're not going to claim those things. Because there's a penalty for that. I told y'all, the IRS, if there's something, they got a penalty for it. So as tax professionals, we have to do our homework. And if something doesn't seem right, we have to ask the questions. And so it doesn't matter if you as a taxpayer don't believe that it's the tax professional's business as to why and who and whatever with these claims. Oh, it absolutely is our business, because it's our job. It's our profession that's on the line. And if we were to continually, file fraudulent stuff, then we can get put out of business. And you see it happening all the time. On about every Friday, there's this thing called the tax blotter, where I read about tax professionals who have been consistently filing fraudulent returns over and over again, get put out of business, also have to pay restitution. That's, the money that they stole. They got to pay it back, and they can no longer practice. I work too hard for my stuff to be doing that just so you can get a couple of, extra $1,000 or something. We ain't doing that. So I'm telling you, if you file your returns as if you knew for sure you would be audited tomorrow, you would be fine. But what we do is, right, we look at, and especially, like people complain about, the at-home tax software. The tax software isn't the problem. It's people playing with numbers that's the problem. You put a number here and go, ooh, that makes me get more money back. And then you're claiming things that you're not entitled to. And then when you get busted, you want to cry the blues because now you got to pay this money back. Or if you got to hire someone to help you, that's going to cost you more money. So just don't do it. If you owe, you owe. It can be worked out. If you owe, it doesn't mean that you have the right or you are entitled to go play with some numbers so you don't have to pay. Because the moment you get busted, guess what? You're going to have to pay more. So I'm just saying, don't do it. Okay? So those are the penalties for claiming false tax credits. You're going to have to pay the money back. You can have up to 75% civil penalty. You're going to have to pay the interest from the time that the tax was due. And oh, by the way, if you happen to have owed instead, you got to pay that money plus penalties and interest. And you can be barred for up to 10 years from claiming that credit again, even if you qualify for the credit. It's not worth it. All right. So that's it for today's episode of Home Biz Tax Talk. Again, we air Monday through Friday, 9:00-ish, and you can come right here to get your questions answered about your home business taxes. All right. Have a great day, and I'll see you next time. Bye.